You ever stop and wonder what keeps the whole global economy from just completely falling apart? I mean, what allows someone to invest billions of dollars into a company they've never even seen? Well, the answer, in one word, is trust. And that trust? It's built on a system called auditing. So, let's get into it.
Okay, just imagine for a second that you own a business. It's your baby. You've put everything into it, but you can't actually run it day to day. So you hire a manager. Now, how do you really know they're doing what's best for you and not just themselves? How can you be sure the numbers they're showing you are legit? This is the exact problem that auditing was invented to solve.
So this breaks down that classic dilemma. Academics call it the principal-agent problem. You've got the owner, the principal, who puts up the cash but doesn't have the inside scoop. Then you have the manager, the agent, who's running the show and controls all the information. Right away, you can see the two big issues. Their interests might not line up, and one person has all the info. Basically, the owner is flying blind. So what do? How do you close that gap? How can you actually verify what the manager is telling you is true? Well, the solution is, in theory, pretty simple. You bring in a qualified, totally independent third party to check their work. And that right there is the heart and soul of an audit.
If we want to get a little more formal about it, auditing is the tool we use to keep an eye on all these different relationships. And it's not just about the owners and managers. It's about making sure everyone who has a stake in the company, we're talking shareholders, creditors, even employees, has information they can rely on. At the end of the day, it's a system of accountability.
But here's the thing, not all audits are the same. It's like you wouldn't use a sledgehammer to fix a watch, right? You got to have the right tool for the job. And depending on what you need to check, there are a few different flavors of audits. Let's take a look at the four main ones.
First up, we've got the operational audit. Now, this one isn't so much about the money as it is about performance. An operational audit basically asks, are we doing things in the best way possible? Are our processes as efficient as they could be? Are we wasting time or resources somewhere?
And here's a perfect way to think about it. An auditor might come in and take a deep dive into a company's payroll system. They'll look at things like how many records it can handle, what it costs to run, and how often it makes mistakes. The whole point is to see if it can be done better, faster, and cheaper.
Next, there's the compliance audit. And this one is exactly what it sounds like. It's all about following the rules. Whether it's the company's own internal policies, complex government regulations, or the fine print in a contract, a compliance audit is there to make sure the organization is ticking all the right boxes.
A great example of this is a bank loan. The bank lends the company a ton of money, but there are always strings attached, covenants and conditions they have to meet. A compliance audit would come in and verify that the company is actually holding up its end of the deal, which gives the bank the confidence it needs.
All right, now we get to the one that most people think of when they hear the word audit. This is the big one, the financial statement audit. Its whole purpose is to give everyone assurance that a company's financial reports, the balance sheet, the income statement, are accurate and presented fairly according to a common set of rules.
So when you hear in the news about the annual audit of a massive, publicly traded company like Boeing, this is what they're talking about. It is a monumental task where auditors sift through mountains of data to verify the financial health of the corporation for its millions of investors around the world.
And finally, we've got the forensic audit. You can think of this as the detective work of the accounting world. Seriously, when there's a suspicion of fraud or some other financial funny business, a forensic audit is launched specifically to dig up evidence that will actually hold up in a court of law.
So who are these people doing all this crucial work? Well, let's meet the auditors. Generally speaking, they fall into three main groups. You have your external auditors. These are the independent pros who come from the outside to do those big financial statement audits. Then you have internal auditors who actually work for the company, helping to improve processes and check for compliance from the inside. And of course, you have government auditors who work for the public to make sure government agencies are on the level.
And look, it's so important to understand that these aren't just random people checking boxes. Auditors are highly qualified professionals. They go through years of education, intense training, and tons of on-the-job experience to earn their credentials and to earn our trust.
Okay, so we've got the company, we've got the owners, and we've got the auditors. Let's put it all together and see how this whole thing works in what you could call the cycle of trust. It's really a simple but incredibly powerful loop. It all starts with the users, like you and me, as shareholders, providing money to the company. The company then takes some of that money and hires an independent auditor to go through its books. And finally, that auditor issues a report that goes right back to the users, giving us that verified information we need to lower our risk and make smart decisions. This cycle is literally what makes our capital markets work.
So, let's zoom out. After looking at all these pieces, what's the big takeaway? Why does all of this matter so much?
It really comes down to this. Auditing is the absolute bedrock of trust in our modern economy. Without it, there's just no credible way to shrink that information gap between the people running the company and the people investing in it. It's the essential gear in the machine that allows money to move around the world with confidence.
And that brings us to one last really important thought. This whole system is built on trust in the audit itself. So what happens when that trust is broken? What are the ripple effects when an audit fails? Now that's a question that has shaped the very rules of our financial world.